One of the fastest ways new traders lose money isn't by picking the wrong stock. It's by choosing the wrong account type before they even understand the rules. Most brokers offer two main account types, but they rarely explain the difference in plain English. Instead, you get hit with terms like cash account, margin account, settled cash, and pattern day trader, PDT. And it can feel overwhelming fast. So a lot of beginners choose the account that sounds more powerful. Then they get blindsided by restrictions and confusion or losses they didn't see coming. That's what we're going to fix today. A margin account can sound like a cheat code. It can give you more buying power, let you trade faster, and remove some limits. It's easy to think, why wouldn't I want that? But here's what most beginners don't understand clearly. Margin can help you, but it can also blow up your account fast. A cash account can feel slow and limiting, but for many new traders, that limit is actually protection. In this video, I'm going to break down what a cash account is, what a margin account is, the key rules behind each one, and how to choose based on a clear plan, not emotion, so you don't learn these lessons the expensive way. At Chart Whisperer, we don't trade to feel powerful. We trade to stay in the game. Let's keep it simple. A cash account means you can only trade with money you actually have. No borrowing, no leverage. If you have $1,000 in the account, that's all you can use. After you sell a stock, that money has to settle before you can use it again. For most stock trades, that usually takes one business day. A lot of beginners hate this rule, but it exists for a reason. It slows you down and forces you to think. Most beginners don't lose because they trade too little. They lose because they trade too much. One of the most important cash account rules is settled cash. You can only trade with money that has fully settled. If you buy using unsettled money and then close trades before the funds settle, you can accidentally trigger violations, and your broker can place restrictions on your account. The fix is simple. Don't use all your cash at once. Split your money into buckets. If you have $1,000, you might use $300 for one trade, $300 for another trade, and leave the rest untouched. That way, if one trade is still settling, you still have cash available. Planning beats clicking every time. A cash account can also help you manage your emotions. When a stock runs without you, it can feel personal. That's when FOMO kicks in, and FOMO leads to chasing. A cash account teaches an important lesson. You don't need to catch every move. You only need your move, the one your trading style was built for. You wait for a clean trend, a clear level, and your exact setup. If a stock runs without you, that's okay. There will always be another trade. Cash accounts also help reduce overtrading. When you have fewer trades available, you tend to remember why you entered in the first place. Think of a cash account as training mode. If your rules don't work in cash, they won't suddenly work in margin. And I'll be honest, I made mistakes early on because I traded too big, too fast, and I paid for it. Bigger position size doesn't fix bad decisions, it magnifies them. That's why control comes first. Now let's talk about margin accounts. A margin account means your broker can lend you money. This gives you more buying power and usually removes most settlement delays. That can sound great, but borrowed power comes with higher risk. More buying power often leads to bigger positions, and bigger positions can make small price moves feel huge. If you can't trade calmly in a cash account, margin won't make you better. It will make you faster, louder, and more emotional. Margin also makes it easier to overtrade because you don't have to wait for cash to settle. If your main reason for using margin is simply to get more action, that's a warning sign. When you're not in a trade, your job isn't to click on anything that looks good. Your job is to prepare. Pick one strong setup and plan the trade before you enter. No plan, no trade. Margin also comes with costs and strict rules. If you hold positions using borrowed money, you may pay interest. And if the market moves against you and your account value drops too much, your broker can issue a margin call. You don't want margin calls. That's when the broker can force you to add more money or close positions, sometimes at the worst possible moment. Here's the basic rule. Don't use margin unless you fully understand your broker's policies. Know the interest rate. Know what triggers a margin call. Know what happens if you ignore it. If you can't explain it simply, you're not ready to use it. Margin accounts can also allow short selling, which adds extra risk. You can face borrow fees, limited shares to borrow, and fast squeezes where the price jumps hard against you. Beginners often get hurt here. Earn the right to short by mastering long trades first. If you want to practice short selling early, do it on paper or with very small size, and always use a hard stop. We start simple. The complex comes later. One more major difference is the pattern day trader rule. In a margin account, if your balance is below the required minimum, and you make 4 or more day trades within 5 business days, your account can be restricted. A lot of beginners get blindsided by this. Cash accounts are not subject to PDT rules, but they are limited by settled cash instead. The key rule is simple. Know the rules for your account size before you go live. Confusion leads to forced trades, and forced trades lose money. A cash account is usually best if you're new, still learning one setup, prone to overtrading, or focused on building skill without blowing up your account. A margin account may make sense later if you're already consistent, respect stops automatically, understand your broker's rules, and can stay calm even when more buying power is available. If you're unsure, start with cash. You can always upgrade later, but rebuilding after a blowup is much harder. Here's the chart whisperer way. Start with a cash account. Trade small. Define your risk before you enter. Use a bucket system. Take 1 or 2 A+ trades per day. Journal everything. Protect your downside. We don't measure success by buying power, we measure it by risk control. You don't need more power, you need more control. A cash account won't make you rich fast, and a margin account won't fix bad habits. They're just tools. The trader matters more than the account type, so keep it simple, trade small, protect your capital. And if you're serious about learning to trade without blowing up your account, subscribe to Chart Whisperer. This channel is for beginners who want structure, calm decision-making, and real rules. It's not for gamblers, it's not for hype traders, it's for people who want to stay in the game long enough to get good. We don't trade with emotion, we trade with structure.